Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is December 8th and this is a weekly markets update. Let's have a look at the news of week 49 and see what are the next trends. Please watch my interview with Wojciech Smolarski, product manager for fertilizers at Polish Agro. That was published last week. We discussed current market status of Central and Northern European markets and expectations of farmers and fertilizers market players from the next year. So don't miss the jazz. In urea market, demand across the globe was slow, so prices on all benchmarks dipped. European buyers are on the sidelines. Only a couple of small inquiries were circulating for last-minute purchases before the year end. But generally, demand will evaporate as of now. Mobco reported sales of two small lots, 5,000 tons altogether, at $450 FOB. But buyers' bids were $440 and less. In Turkey, demand is seasonally increasing, and fresh Iranian cargoes were sold around $415 to $17 CFR last week. Iranian producers all operate at full capacity, without usual stoppages due to natural gas curtailments. Their target FOB price remained at $375 level, but surely will go down in line with global price level. However, colder weather perhaps will arrive later in December or January, so gas curtailments are still expected. In the Middle East, there were no fresh deals registered. Nominal prices moved downward to $390 to $400 FOB range. In the Southeast Asia, floods delayed urea application. Many fields are underwater, as well as fertilizer stocks. The situation needs to settle before importers come back to the market. In Brazil, prices moved more down to the range between $395 to $415. Iranian and Venezuelan tons are sold at the lower side of the range and weigh in the market. More demand is expected to emerge in December in front of Safrinha corn season, but, as we discussed in previous weeks, buyers will be looking at nitrogen cost per unit ratio in urea and sulfate before taking purchasing decisions. In current situation, when sulfate price increases and urea drops further, the choice will be for urea, but situation might flip later. In the US, demand was subdued, so prices dropped more by more than $13 per short ton. NOLA range dipped to $353 to $58 per short ton. US market is expecting 6 vessels from Qatar priced on formula to arrive within next month, which will be the start of the next year purchasing season. In nitrates market, demand in Europe has slowed down because there is no space left in warehouses to stock more product. All terminals and warehouses are stocked to capacity by importers who bought a lot of AN and CAN ahead of this CBAM. Egyptian NCIC sold 15,000 tons of CAN at higher than $320 FOB level in its latest tender. However, this is not officially confirmed by the producer. In Ukraine, demand is strong ahead of spring application, and seaborne imports ban puts pressure on prices. Domestic producers TEM raised price last week, and import products will follow, of course. Still, it is unclear if the market is able to import all needed product with railroad and trucks only. In Brazil, Russian producers have increased export offers to $295 to $300 CFR, tracking the recent increase in European prices, as well as demand from the US. However, market players think that the ceiling is approaching or already reached. In the ammonia market, Tampa price for December was agreed last week, and as expected, it is a rollover from November at $650. And in general, price has stabilized after many weeks of increase, especially west of Suez, which is mainly due to positive news from Gulf Coast Ammonia plant in the US. Expectation in the market is that the producer will supply around 100,000 tons of product in December, which, if happens, of course, will ease the supply pressure. Nutrient production in Trinidad is still down. However, other producers are operating full scale and exports are healthy. European producers are enjoying low gas prices that hit 18 months low last week. There were no fresh ammonia imports registered, and new deals are unlikely in front of CBAM for some time at least. In the Middle East, FOB level also remained largely unchanged, around $500 plus for spot cargoes, but contract prices increased more. Ma'aden production will not come back on stream at least until January, but in any case, restart time is approaching quickly, and prices will reflect this expectation. Demand from India was relatively strong and prices climbed more last week. CFR level was assessed in the range between $500 to $545, while buyers' bids are around $520 to $30. However, demand for complex fertilizers is coming to its end, so demand for ammonia will decline in January, together with the price, of course. Indonesian producer Parnaraya sold a spot cargo last week at $480 FOB, and Pupuk also has spot tons to offer in December. In the phosphate segment, prices continued to come under pressure, as buyers' interest was more and more subdued. In India, there are rumors about possible DAP sale at $670 to $75 CFR range of Russian origin, but from the other hand, sources indicated that even $650 CFR level will not be interesting for buyers. The affordability remains low, and also the congestion at the ports is becoming a serious issue. Some say that 10 to 15 days waiting in the ports of West Coast is a new norm now. And of course, Indian buyers are largely avoiding fresh purchases due to uncertainty around subsidies and maximum retail price. Without clarity on these factors, they are reluctant to carry over stocks into the new season. Despite high offtake levels that continued in December, stock level stays around comfortable 2 million tons level, which is expected to roll over to the next year. Chinese producers either are sold out or committed till the end of the year, and very few uncommitted cargoes are available in China now. Export activity was subdued last week, so price for DAP remained unchanged in the range $680 to $90 FOB. Producers are getting ready for domestic market. European demand was very slow, but some tons from Morocco and Tunisia are moving though. Egyptian sales tender that was finalized last week and included 80,000 tons of DAP. The result is not very clear. It was not officially announced. Rumors from NCIC side put FOB price level at $760, but obviously in current market situation it is unachievable. So let's see where these tons will end up and at which price. OCP reported sales of more than 30,000 tons of DAP to various European markets in the range between $700 to $725 FOB. In fact, market is already seeking for lower than 700 indication. Ma'aden reported its first sales to the US market since March this year, 180,000 tons for December loading on formula basis. It is the first sale since March. After that, in April, reciprocal tariffs imposed by President Trump administration actually restricted Saudi Arabian product imports. So now, after lifting of reciprocal tariffs, perhaps Ma'aden will come back to the US market, lifting the pressure from US farmers. NOLA last week again was lacking liquidity, although spot prices continued declining. The DAP barge assessment for January declined to $630 to $50 FOB range for short ton, while MAP price went down to $625 to $30 FOB per short ton. In Brazil, the activity was low as well, and prices continued sliding. MAP price was assessed at $630 CFR, but inland prices from warehouses are about $10 lower than that. TSP was heard at $515 CFR level, product from Morocco. Moving to the fundamentals. The unusual situation in the gas market continues. European natural gas futures fell more to 27 euros per megawatt hour, which is 40% lower versus last year. Prices have come under pressure as US-led ceasefire talks between Ukraine and Russia raised the prospect of an end to the war and the potential softening of EU sanctions on Russian energy. Record US LNG exports have also helped keep prices in check across both Asia and Europe, while Norwegian pipeline flows have remained steady. Meanwhile, LNG demand in Asia has been subdued, and weather forecasts point to warmer than usual temperatures across much of Europe, suggesting heating demand will stay muted. As of November 29, EU gas storage facilities were 75% full. US natural gas futures, on the contrary, hit above $5 per MMBtu mark, hovering at 3-year highs, amid a backdrop of soaring export demand. European countries extended their shun of Russian natural gas and confirmed the complete phase-out of Russian LNG by the end of 2027. This coincided with fresh evidence that US LNG exports rose 40% annually in November to 10.7 million tons, even though producers continued increasing output. Demand was also underpinned by forecasts of a cold front provoked by polar vortex. The first of 3 rounds of cold Arctic air from a shifting polar vortex has sent temperatures plunging across the central and eastern US, threatening centuries-old record lows in cities and towns from Iowa to Maine. The latest Energy Information Agency data showed that utilities withdrew 12 billion cubic feet of natural gas on the week ending November 28. Meteorologists forecast 2 more blasts of frigid temperatures over the next 2 weeks. Agricultural commodities futures moved in different directions last week. Wheat futures slightly rebounded from the last week, but in general fluctuated at the similar level. In the US, about 48% of the winter wheat crop stayed in good to excellent condition, which is down slightly from 55% last year. However, wet conditions delayed planting in some areas. In terms of exports, there are some challenges, as tightening railroad capacity and elevated secondary rail freight pressured values as the soybean export program picks up speed. Ample global wheat harvests continue to be a dominant trend, as Statistics Canada raised its 2025 Canadian wheat production forecast to 40 million tons. Corn futures hovered at the level similar to last week. According to the US Grains and Bioproducts Council's 25-26 corn harvest quality report, the 25 US corn crop is projected to be the largest on record, coming in at 425.5 million metric tons. The crop is also highlighted by the lowest rate of broken corn and foreign material in the report's history, a remarkable accomplishment for the entire US corn value chain. Export and ethanol demand for corn are exceedingly strong. Commitments to purchase US corn by overseas buyers is up 31% year over year to 37.4 million tons. All these factors hold corn price from the rally. Soybean futures slipped modestly to $11.05 per bushel as the market lacked fresh demand catalysts and expected a strong South American harvest. Brazil's 25-26 crop is forecasted to hit a record high, though drought risks in the southern regions remain under close watch. As of November 29, planting progress in Brazil stood at 86%, up from 78% a week earlier. All eyes are at China now. Announced sales to China since late October have reached just over 2.7 million tons. Sales will need to reach just over 700,000 tons per week through the end of February in order to reach 12 million tons, as suggested by US Treasury Secretary Bessent. It would appear to be a tall order, with Brazilian FOB offers 70 to 90 cents below US for Q1 shipments. Moving to the shipping industry. The Drewry World Container Index rose 7% last week after 3 weeks of decline. Rates on the Trans-Pacific head haul finally recovered. Spot rates from Shanghai to Los Angeles climbed 8%, while those to New York rose 6%. Shifting away from traditional fortnightly adjustments, some carriers have adopted a weekly strategy for general rates increases. Instead of announcing large hikes that tend to erode quickly, carriers are now introducing smaller, more frequent increases to maintain consistent upwards pressure on spot rates. This strategy appeared to have been effective last week. Spot rates on the Shanghai-Genoa route increased in double digits, rising 15%, successfully sustaining rate levels for 3 consecutive weeks. The uncertainty surrounding the Suez Canal is adding volatility to the Asia-Europe trade lanes, since carriers continue to view the Suez as the natural route between the two regions. A full resumption of transits would return significant capacity to the market and exert downwards pressure on rates, although the effect would likely be gradual due to possible congestion at ports following the realignment of east-west networks. The Baltic Exchange Dry Index climbed more versus a week ago. The Capesize market delivered a firm performance last week, especially in the North Atlantic, where the pronounced tightness triggered a sharp midweek rally. In the Panamax market, the week opened on a softer tone, as prompt tonnage increased across the Atlantic and Asia, and this trend hasn't changed over the week course. For Ultra-Supramax segment, it was a positional week, and stronger demand was seen only from the Indian Ocean, while elsewhere the rates were under pressure. The Handysize market displayed a mixed performance, with limited activity in continent and Mediterranean, while the US Gulf and South Atlantic held very firm. To sum up, after finalization of the Indian tender, global demand is mostly subdued and price slid across all benchmarks. European demand finalization and pause before purchasing starts in the US and Brazil will push urea prices further down in upcoming weeks. Ammonium sulfate price for standard product continued increasing due to supply tightness, while granular product price seems to have reached its ceiling in Brazil. Ammonium nitrate demand slowed down and price remained unchanged last week. Ammonia price finally stabilized due to Gulf Coast Ammonia plant production restart. Phosphates demand continued to be very slow, that weighed on prices across the globe. Natural gas price in Europe dropped to 18-month low due to warm weather and very healthy LNG flows. US price jumped amid continuous cold front provoked by northern vortex. Wheat futures rebounded slightly due to logistical limitations influencing short-term exports, while corn futures hovered at a level similar to previous week. Soybean futures dropped amid Chinese purchases lagging behind target levels announced by President Trump administration previously. Container shipping rates increased on the background of carrier effective strategy of general rates increases. Bulk shipping activity was strong, especially in Capesize segment. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.